The Forex market, a vast ocean of currency exchanges, offers thrilling opportunities for profit. But like any ocean, it has its share of storms and calm waters. Trend following is like being a skilled surfer riding the waves of currency movements for consistent gain. In essence, trend following is about identifying and capitalizing on the prevailing direction of currency price movements. Imagine trying to sail a boat without a rudder or a sail. Trading without a trend-following strategy can feel just as chaotic. You're at the mercy of every market fluctuation, tossed about with no clear direction. Trend following provides that rudder and sail, giving you a systematic approach to navigate the Forex seas. Trend following is not about predicting the future, it's about recognizing the present. It's about understanding that currency pairs rarely move randomly. Instead, they often follow trends, moving in a particular direction for extended periods. By identifying and capitalizing on these trends, traders can potentially achieve consistent profits. Whether you're a novice trader dipping your toes into the Forex market or a seasoned professional seeking to refine your approach, understanding trend following is essential. By the end of this essay, you'll have a solid grasp of this powerful trading methodology and be well equipped to start riding the currency waves to success. Trends are the lifeblood of the Forex market. They represent sustained movements in currency prices, offering savvy traders the potential for significant gains. Understanding why trends are crucial for consistent profits is paramount. Firstly, trends provide a clear direction. In the often volatile Forex market, knowing whether a currency pair is likely to rise or fall is invaluable. Trend following helps traders identify this direction, allowing them to enter trades aligned with the prevailing market momentum. Secondly, trends offer prolonged opportunities. Unlike short-term market fluctuations that can reverse quickly, trends can persist for weeks, months, or even years. This extended duration allows trend followers to ride the wave of price movements, maximizing their profit potential. However, it's important to remember that trends are not constant. They can change direction, and what goes up will eventually come down. Therefore, successful trend following also involves recognizing when a trend is weakening or reversing, exiting trades before potential losses escalate. By understanding the nature of trends and their significance in Forex trading, you can begin to appreciate the power of this approach. It's about aligning your trading strategy with the natural flow of the market, harnessing its momentum to your advantage. Now that we've established the importance of trends, let's delve into some key strategies for successfully navigating them in your Forex trading. One popular approach is the moving average crossover strategy. This involves using two moving averages, one long-term and one short-term, plotted on a price chart. A buy signal is generated when the short-term moving average crosses above the long-term moving average, indicating a potential uptrend. Conversely, a sell signal occurs when the short-term average crosses below the long-term average, suggesting a potential downtrend. Another widely used strategy is the breakout trading strategy. This involves identifying key support and resistance levels on a price chart. Support represents a price level where buying pressure is expected to outweigh selling pressure, preventing further price declines. Resistance, on the other hand, is a price level where selling pressure is anticipated to overcome buying pressure, limiting further price advances. Breakout traders enter trades when the price breaks above a resistance level, signaling a potential uptrend, or below a support level, suggesting a potential downtrend. These strategies, while effective, are just the tip of the iceberg. Numerous other trend-following strategies exist, each with its own set of rules and risk parameters. The key is to find an approach that aligns with your trading style, risk tolerance, and financial goals. In the world of Forex trading, identifying and managing trends is crucial for success. There are several tools and techniques that can help traders in this endeavor. One of the most commonly used tools is the trend line, which is drawn on a price chart to connect a series of higher lows in an uptrend or lower highs in a downtrend. Trend lines help traders visualize the direction and strength of a trend. Another essential tool is the moving average, which smooths out price data to create a single flowing line that can help identify the overall direction of the market. Additionally, traders often use indicators like the Relative Strength Index, RSI, and Moving Average Convergence Divergence, MACD, to gauge the momentum and potential reversal points of a trend. By combining these tools, traders can develop a comprehensive approach to trend identification and management, increasing their chances of making successful trades. Remember, the key to effective trend following is not just identifying trends, but also knowing when to exit a trade. By staying vigilant and using the right tools, you can navigate the Forex market with confidence and precision.